G'day, welcome to the Financial Bloke Podcast, the podcast for people seeking the wisdom needed to grow their family's wealth and live a happier, healthier and more prosperous life. My name's Ben Law and I am the Financial Bloke. So today I'm really excited to have a bloke by the name of Tim Rivett here with us. Tim's a lawyer, but don't hold that against him, and in my opinion, one of the really good ones. I got to know Tim over the years professionally, working with him to help my financial advice clients with things like asset protection and structuring and estate planning, property conveyancing and anything legal really. And we really worked well together. Now, Tim and I have got a lot in common. We're both young-ish. I like to say young-ish because it's no longer young, but we both have a beautiful daughter each and we're tightly twisted around their little fingers. But the best part is we're both always looking for ways to grow and improve ourselves and are both true lifelong learners. Now, when Tim and I started talking about doing a podcast together, we thought we'd start with something really obvious like some sort of legal topic like estate planning or asset protection, tax or something like that. And we thought that'd be really technical, people might be interested, but it's possibly going to be a little bit boring for some. And then Tim thankfully suggested, he said, let's have a conversation about financially assisting your kids and your grandkids, because that's a topic that I've had discussions with clients over for years, more times than I can count, and so's Tim. So here we are. So g'day, Tim.
G'day, Ben. Thanks for having me.
My pleasure. My pleasure. It'll be great. So we're going to have a bit of a laid-back conversation today. So to start off, can you give us a bit of a better understanding of yourself and tell me about one of your personal values and how it's shaped you into the person you are today or why it's important?
Yeah, so Ben, like you said, I'm a lawyer. Please don't hold that against me. That's just my day job. But I was very lucky to have been trained in a big Brisbane law firm. Fantastic place to get my training and cut my teeth. But I always missed the regions. I grew up more regionally and I really missed that lifestyle and that way of life. So I now have a really small boutique practice based up in Yeppoon in central Queensland, and I am very much exposed to helping farming and grazing and business clients with many aspects of their day-to-day businesses, all sorts of things through estate planning and succession planning, and that's why this topic is so relevant to me because, like you say, we do help a lot of clients in this exact situation. My personal value, I suppose, that gave rise to this is the concept of a thirst for knowledge. Ben, I know that sounds like a really silly thing to say, but as a kid, they thought I had a bit of ADHD, but I didn't. I just had a lot of energy, and I just needed to know things. Well, I did. Yeah, you did. Maybe I did, but it wasn't categorized, wasn't diagnosed, but to be honest, I just had a hard time doing one thing and one thing only. I wanted to do lots and lots of things. I wanted to know everything, and I was quite an annoying child because I was always asking why, which is age appropriate as a youngster, but that never really changed for me. And even today, if somebody says some little saying or idiom, then I have to look it up and I have to find out what the origin of that thing is, and I can't go to bed until I know what that's all about. So, yeah, the idea of continuous knowledge and that thirst for knowledge, that's really something that's given rise to my practice, but also who I am today. I'm interested in lots and lots of different things, and that's why I'm delving into the world of podcasting because I've enjoyed so many podcasts over the years and really enjoy it.
Well, it's interesting, Tim. I was exactly the same. I think I was one of those annoying kids that used to ask why. My dad used to take me to bull sales and to the sale yards and things like that. And I think he must have got sick of hearing me asking lots of questions. And I remember he used to sit me on a fence post or on the rails in the cattle yards and leave me there with someone, and he'd say, have a chat to that old bloke. And probably back then the old bloke seemed as old as the hills to me, but it was probably my age now, and say, he might be, yeah. And he used to say, just ask him what he'd do if he had his time again. And, of course, I'd sit there questioning as a little, probably 4 or 5 right up till teenagers. Why is this happening? Why has that happened? What's happening here? And I'm sure they used to pass me around and get sick of hearing it. So I'm just like you. And I think it's really, really nice to see. I know I see that in Sophie, that real curiosity. So it's actually something I enjoy fostering as well, which is good. So, okay, excellent. Well, let's get cracking today. So obviously we talked about the fact that more and more people are wanting to help their kids and grandkids. And I gave this a lot of thought over the weekend trying to think about, well, what's changed or has it changed? Are people wanting to help their kids more these days, or is it always been like that? We just haven't been around. So what are your thoughts on that, mate? Do you think we're seeing people more and more want to, or not?
I think perhaps it's always been a desire for people. They've always wanted to give their kids a leg up. Perhaps over the generations, there's always been a focus on that. I have a theory on that, Ben, that it's a product of the national wealth, that people are in a much stronger position nowadays to actually do it. So the desire perhaps has always been there, but the ability to do it, I believe, has grown, particularly over the last 20 to 30 years, with Australia having a pretty good run of things, and Australians becoming wealthier as a very general rule. But there's also a few factors that throw into that is something that we will talk about and everybody wants to talk about, is younger people trying to get into the property market and how difficult that can be. Yes, property is expensive, and when you look at some statistics and compare that with the purchase price versus annual wages over the last couple of generations, there's no doubt that it is more difficult. But I do think that the desire has always been there, but those mechanics now and the ability to do it is much more relevant. I have another theory that with the ageing population, Ben, too, that if you look at people live till their mid-80s now, and their children, depending on when they had children, are in their 50s and 60s by that stage. So if you think about, I've got a very young daughter like you, she's not even 3 yet, and I want the world for her, I want the best for her, and you start thinking about ways that you can help. And as young kids, it's more about education and their advancement in life. But then you sort of think, what can I do when she's in her teens and when she's in her 20s and then 30s? And you look across people we know and people in our client bases, they probably don't need the help by the time they're 50 or 60. Hopefully they don't. Hopefully they're in that level of comfort by that phase of life. But if you wait until you actually pass away now, your children are probably past the point of needing it. And will it make an enormous difference to their life in that 50s and 60s? So I think that's driving people to wanting to do it while they're alive and while their progeny, while their kids, grandkids, whoever are in that phase of need. And we are seeing that a lot across that skip the generation and help the grandkids, which I'm sure is something we will touch on in this podcast.
Yeah, I think you're right, and I look at a couple of the issues. Is yes, more money. There's more money floating around, so people have got the ability to help in some ways. If I look back to when my parents were having, myself and my sisters, my grandparents just didn't have the financial means to really help out. I think we're having a lot fewer kids these days. Like if I look at my mum's generation, I think she was one of 6. I'm one of 3. My daughter's one of 1. So the capacity to help, 1 is so much easier than 5. So you've got a lot more capacity to be able to do that. And it's something that sort of came to mind when I was thinking about this is my mum used to always say to me when I was little, get a financial education, Ben, and do better than us. And I think every generation that comes through wants their kids to do better. And for my mum, it wasn't helping out financially. It was educating and pushing us towards getting a better education to hopefully do better ourselves. Whereas a lot of the focus these days, that just becomes a given. And now it's about, well, how can we help them monetarily, like give them a deposit for a house or pay off their HECS or something like that. So I just think things have changed. And also too, as a financial advisor, you see grandma and grandpa, they retire. There's a big bucket of money, generally, a lot more than they've ever had when they retire in their superannuation or they sell the farm or the business. And so it's so much easier to dip into that than it ever was before. Definitely.
And, a gift can seem like an insignificant portion of that bucket of money. You think, oh, well, it's helping them buy a car, or it's helping them with their HECS debt, or even towards a deposit for a home. And you think, well, I've worked really hard and I've retired comfortably, so I can afford it. And that's one of the things that I do want to touch on, Ben, is making sure that before you delve down that rabbit hole, that you actually understand the commitment that you're going to make and that someone is now expecting you to make or relying on you to make, that it doesn't always mean one drink from the well. It often means, oh, thank you very much for that. That's a good down payment. And now I'd like the further economic support if the offer is there. And once you open that door, it sometimes can be a little bit difficult to close.
And that doesn't mean your kids or grandkids are bad people. It just means that they may not have a concept of how much is a lot of money. You might have not enough to comfortably retire on, but to your kids or grandkids, they don't know how much you've got or how much you need. And therefore, it becomes very easy to go, oh, well, mum and dad have got plenty of money slushing around in their account or their super fund. So therefore, it's not a big deal. But to mum and dad, it could be a big deal, especially when we look at now the life expectancy people have. I mean, my great-grandfather passed away. He came back from the First World War, back onto the farm. My grandfather went back and started working on the farm with him, and he was dead by the time he was 66. And so, and my grandfather, who took over the farm when his father died, he died at 92. So we're starting to see that people's requirements for income is so much longer than ever before. So if you're 65 or retiring and you say, oh, I'll just help out the kids here and the grandkids there, you've got 35 years worth of potential funding that you've got to meet. And money being chipped away right at the beginning can have a big impact at the end, especially with aged care getting more and more expensive.
Definitely something you would have come across on almost a daily basis, Ben, is when you're designing a financial plan, none of us know how long we're going to live. If we all knew that, it'd be much easier to budget for that, wouldn't it?
Yeah. Well, what is it Sarah says? She goes, I know how I'm going to live. And I'm like, oh, how long's that? She goes, longer than you. So, yeah. And look, it's a really tough one because quite often people, if you think about farmers and graziers, I look at my parents and money's never just slushing around in the account. They're generally asset-rich, income-poor. Business owners are the same. People who work in say, professional jobs or just even a normal job like a hairdresser, maybe they put money into super. It's not accessible. So you hit that retirement and then all of a sudden all this big pot of gold becomes fully accessible. So it becomes very easy to convince yourself that, we'll just jump into this at 20 grand here, 5 grand there, 10 grand there. It's not a big deal, but it becomes that death by 1,000 cuts, doesn't it?
Yeah, you're right, Ben. It can seem like an insignificant proportion, but if it's a continuation and multiple payments over multiple years, and one of the best examples we come across is education for grandchildren, particularly school fees and things like that. So what we help a lot of clients with is understanding the commitment that they're about to make. If you've got 2, 3, or sometimes even 5 or 6 grandkids, I know families are getting smaller, but depends on how many you're blessed with. You multiply that by the number of years that they're going to be at school, and you've really got to understand what you're getting yourself into, because you don't want to get into a situation where they're halfway through their education and suddenly, for financial reasons, you're forced to turn that tap off. That can really be a very awkward situation for a family. It's very, very tough on everyone. But the financial reality is you really have to take care of yourself first. And like we talk about, put that oxygen mask on before you can help other people, when you're on the plane. But understanding what you're getting yourself into, which seems like a wonderful altruistic help my family arrangement, but really understanding where the boundaries stop is an important thing before you start it.
Excellent. Yeah, I agree. And I think another reason is, Tim, is we're seeing divorce is more common than ever. I don't know what the stats are, but I think it's almost 50% or maybe more of marriages actually fail these days, or relationships fail. And so we're finding a lot more, shall we say, kids are getting to, say, 30, 40 years of age, say our age, and then all of a sudden get divorced. That puts them under severe financial pressure, because whenever people get divorced, generally there's a reduction in living standards and maintenance or sale of assets, etc. And then parents feel that obligation at that age. If their kids, say my parents are, dad's 72, mum's 66, and they're at that what you'd call retirement age. So if their kids get divorced around this age and they see them under financial duress or not being able to afford the kids' school fees or whatever it might be, and they go, oh, well, I've retired now, I've got this bunch of money, they feel more obligation to be able to help out. And I think that happens. And the other thing today is I think the pressure that people put themselves under financially is a lot greater. So many more people are sending their kids to private school now. I see that as a big issue. I look at We've got one daughter who's now 5 and is going to school next year, and you start looking at, if you send them to private school, how much a year it's going to cost. You work that out by 12 years. That's substantial. Now, if you've got someone that's got a couple of kids or 3 kids and they commit to that early on, it's very hard to pull out. The second thing is people are taking on more debt, so they're getting under more and more load of debt. So then mum and dad see them and go, oh, gee, the kids are really doing it tough with the interest rates. We might pay their debt off. Say they sold a farm or a business, or we might pay that debt off, or we might just help them out with the interest payments this year. And so people are much more comfortable living under massive debt and also on the knife edge financially, and having a commitment with the kids that, it appears to be a greater need for assistance, if that makes sense. I'm not sure that's right, but it's because a lot of it's a lifestyle choice, but still it appears to be a greater need.
Yeah, you're right. It definitely is a lifestyle choice, though, which sometimes is hard for the older generations to look at the way that leverage is used and attitude to debt and, the European cars people drive and all those types of things. But then when that awkward conversation comes about financial support, I don't blame people for saying, well, live within your means. That's rule 1. And I'll help you if I feel like it. But I do think that the propensity to load up on debt, particularly at the moment, Ben, because we've never seen interest rates so low. For those of us who are a little bit older, do remember that they were higher, but certainly not the 15 to 17% that our parents' generation talk about when they bought their first homes. But there will be interest rate rises, and I just don't think people necessarily have contingency plans for what's going to happen in 3 to 5 years. And the sorts of financial pressure that might put them under when they've also gone and made those financial commitments like kids in private schools and those types of things. So you're right, the need is certainly there. It's a lifestyle attitude. We are the lucky country and we certainly live it that way. But there's also been a lot of economic success, I suppose, over the last 20 to 30 years for a lot of Australians. And that contributes to, like you talk about, that bucket of money. And that perception that the baby boomers have a lot of money, so the economic support is very doable for them.
Absolutely. So one of the things I wrote down, Tim, and I think I mentioned this when we were chatting about the other day, but I read somewhere, and I'm going to absolutely butcher this, but I think when it comes to helping your kids and grandkids, and just remember, I've got a 5-year-old daughter, so I try and do everything I possibly can to give her a better life, but I'm conscious of that. Just sometimes you've got to let them fail. Sometimes you've got to put them under a bit of duress for them to grow. But I think when it comes to helping your kids and grandkids out financially, is intentions are irrelevant. All that matters are outcomes. And what I mean by that is you can have all the best intentions in the world to help and assist, and it makes you feel good, or you feel guilty, maybe some people. But at the end of the day, it's what the outcome is that matters. So, for example, if you give your kids money all the time, and I see this regularly, you give your kids money, and then eventually what happens is they come to expect that. Is that the best thing for them? And I think I use the analogy of the old, give a man a fish and he'll eat for a day, teach him how to fish and he'll eat for a lifetime. I think there's a certain amount of consciousness. You have to be aware that it's the outcome that's the most important part. And as a lawyer, I'm sure you'd see that all the time. People do something and they say, oh, my intention was to do this, and you have to deliver the bad news. Well, sorry, your intention was to do that, but what the law says or what your contract says is something completely different.
Yeah, the law can really ruin your day, Ben. We don't always give good news. We try to, but we don't always. But you're right that you can enter into an arrangement like this with the best of intentions, and it's a really altruistic, legacy-based plan. But people do have to understand the consequences of that financial support. You don't want to be so generous to the future generations that it dulls their enthusiasm to go and make it for themselves, because that's not just about money. That's about self-fulfillment and, doing something meaningful with your life. But it's also, I suppose, not wanting to expose the assets to risk, which we just briefly touched on family law. So let's drill down on that, because it is a very, very hot topic and the statistics are alarming.
And what you mean by family law, Tim, is divorce, essentially, isn't it? Whether you're married or in a de facto.
Yep, married and de facto makes no difference nowadays in a family law context. So people get together, they separate, and the law doesn't care whether you were officially married or whether you lived under the same roof for a year. So helping your children or anyone associated with you has risks, and that family law separation does expose those risks, whether that was a gift of cash or cars or a guarantee relationship on a loan. All those types of things need to be considered. That what if this relationship doesn't last? And it's a horrible thought, because sometimes it's at a period when the relationship is new, or the young people have just got married and you want to help them and give them a leg up. But it's around half the relationships nowadays that people enter into don't go the distance. And you've worked really, really hard for your wealth, and you've made sacrifices. The very last thing you want to do, unless that's your plan and you've understood it and committed to that, is to see that brought forward inheritance and that financial support go into the arms of an ex-daughter-in-law, son-in-law. And that's something we deal with on a daily basis in our practice, because there's a lot of concern around the what-ifs around the family law.
So, I mean, from my point of view, Tim, what I would see is a gift of an asset, and that's usually in the farming realm. So in other words, my son or daughters come back on the farm, I'm going to gift them one of the blocks of land or transfer it into their name or sell it to them for substantially less so they can get ahead. That's probably the obvious one that we'd talk about today. And I think that's usually dangerous, isn't it? In the sense that you have no control once you've handed over that asset. Is that sort of the major one you see, Tim, or is there some other examples? Yeah,
definitely, Ben. It doesn't even need to be on that scale. It can just be a gift for a residential house deposit, which, don't get me wrong, is a lot of money in capital cities nowadays. But because a lot of our clients are business owners and agribusiness clients, they're asset rich and cash poor. So a lot of their assets tend to be the family farm or grazing or farming properties. And yes, if you're generous to your children while they're alive and you want to get them into a position of control while they're young, that's fantastic. But once that asset becomes their personal belongings, it is up for grabs in terms of family law matrimonial pool, as they call it. And you do need to tread lightly about how and when you do that. But there are some really great strategies to protect those assets, but still provide that financial support. But it is about understanding that and getting that advice before you jump into that arrangement. Because once it's done, it's really, really hard to go back retrospectively and document something and say, well, this is what we meant when we did that 3, 5, 8 years ago. Intention, we talked about, that everybody had that intention back then. Doing anything in hindsight is always very difficult. And the law also takes a very dim view of trying to cover your tracks, once perhaps some stormy seas or the relationship doesn't look as rosy as it did a few years back. If you try and plug that leaky dam, so to speak, at that stage, then it's going to be seen for what it is and unwound.
Yeah, and what is it someone said to me once? They said, Ben, it's easier to come up with an agreement when you're in love than when you hate each other. And so having that discussion up front about how it works, what this assistance is, whether it's a gift or a loan or considered to be coming back, is really important to be done up front rather than when there's some sort of animosity. Because whenever you see a split up of some sort of relationship, whether that be a partnership between friends or business associates or personal relationships, it does always get messy. And you'd know full well, once the two parties, their new spouse or their friends or their lawyers get involved and see the pool of money, that can change the way they view the original agreement unless it was documented. Today's episode is brought to you by AgriCoach. You've worked bloody hard over the years and you've built a solid operation. But as your children grow up and start their own journeys, you're beginning to think about the next 5, 10, and even 15 years and how to keep driving the business forward and ensure a smooth and successful succession plan. Preparing the business, preparing the next generation, and preparing for your eventual retirement all requires a solid plan and a proven process. Unsure about the right steps to take? Head on over to agricoach.com.au/webinar to learn more about our Succession Proof Your Family webinar. AgriCoach, aligning families, growing wealth, and protecting legacies. And now, let's get back to the episode.
Definitely right. And that documentation doesn't have to be particularly complicated, Ben. That's the thing that we tell lots of our clients is it doesn't need to be a set of loan documents similar to what you'd get from one of the big four banks. It can be a much shorter form arrangement. It's the fact of its existence that is important, and the fact that everybody entered into it and signed it, like you say, when they were in love and they were very keen on getting the financial support. And it's a bit like insurance. You put it in place and you hope you never need it, but it's there if you do need it. And it's a bit of a peace of mind thing. We're very big on peace of mind with our client base. We want them to walk away from us with that comfort that there is a plan in place and that the plan was at their making and at their desires. And that covers off a lot of different things, but it doesn't necessarily need to be the War and Peace version of the documentation. It just needs to be enough to protect everyone.
Yeah, for sure. And there's some real positives with being able to help out your kids or grandkids, isn't there? Like if I look at it, I sort of go through and go, well, the number one we usually see is helping them buy a house, because houses are getting more expensive. You look at, if you need a 10 or 20% deposit, the average house, I think the average loan size now is like $500,000 for a first home. I think if you look across Australia, obviously in the city it's a lot more. I think in Sydney it's 1.5 million now for the first homeowners down there, which is just mind-boggling. But if you get out the regional areas, so you'd know that in Yeppoon and Rockhampton, you don't necessarily get a McMansion, so to speak, for $500,000. So getting together that house deposit or helping out with that can be really important. Educating their grandkids. So for some people to be able to say, right, well, we'd like to help educate the grandkids out, that can be a positive. It can be helping them out of a financial hole. So if your kids fall into a financial troll, like they make a mistake in business or they just fall into a hole by no fault of their own, things like drought or economic downturn, interest rates spike temporarily, can be a real tough time for them. They go through a divorce or maybe even have some health problems. You see that all the time where someone has, someone gets sick and can't work or has a major car accident or something like that, or maybe even loss of employment. So it's actually, it can be good to help them out, but they all come with hairs on them or problems potentially if you don't do it right, isn't it?
Yeah, there's definitely risk, but what we try to help and educate our client base with is the positive outcomes that we've done this very successfully with lots of different families. And yes, there's some examples we can give where it wasn't done properly, and unfortunately we've had to intervene and try to fix things as best as we could. But I like to tell people about the really positive outcomes and how arrangements were thoroughly considered. There was transparency during the process. There was some documentation so everyone knew where they stood and the what-ifs were covered off. And it's a real joy for people to be able to help their descendants, or it doesn't have to be a relative. Lots of people out there want to help people who were kind to them at various points in their life. And it could even be, your peers who are of a similar age but haven't had as good a journey as such to where they are today. But you do see the joy in people to be able to give back in that meaningful way. But what we say to them is, you really need to enter into the arrangement on the assumption that you are never going to get that money back. Okay, it's a gift, not a loan. Don't be naive thinking that if you loan, say, your children some money, they'll go off and make really great lives of themselves, and then when it's your turn to go into aged care, they're going to give you that money back. Now
a lot might, but you should go into it believing you won't get it back, I think is probably, because I've seen a lot where it has come back. Where the kids have gone out and mum and dad have helped them into their first home or got them out of a hole somewhere. They've been really appreciative. They've all had the agreement. They've paid the money back and mum and dad are happy. But I've also seen probably far more where they've gone into the transaction. And I'm thinking of a client right off my head now that lent their kids $50,000 each to buy their first home, and always on the basis that the money would come back. It never did. And he's okay with that. It's not the end of the world. He financially could afford it, but still, don't delude yourself into going, oh, this is definitely going to come back. You need to almost be okay with the fact that if it doesn't come back, it doesn't come back.
Yeah, which of course is easier said than done.
Of course,
Ben, I have an almost 3-year-old daughter now, and if I'm a professional negotiator, in my business and in my day job.
Give her two years and she'll have out negotiated you, I promise you.
Yeah, she's pretty close already. So I get the rose-coloured glasses, and I understand that instinctive desire to make sure your tribe does, as best as they possibly can. But it is really easy to lose that objectivity to say, well, is this really a good idea? And if it is a good idea, how should I do it and how much? But we do say to people, although we do structure a lot of these arrangements as loans, that is an asset protection strategy, but please don't rely completely on getting that back, because particularly if it's a support for a business, businesses are very risky. The statistics on business are just as alarming as the family law relationship breakdowns. So particularly during these COVID pandemic times. Wow, Ben, I think we went half an hour without mentioning COVID. That must be some sort of podcast record for 2020
I'll edit that
and 2021. Yeah, we'll edit that out. But, there are certain industries that have been really detrimentally affected by what's gone on in the last 18 months. And so if you were a financial supporter of a restaurant for your child, for example, then that money has always been at risk, but even more so in the last 18 months. So if you are absolutely relying on that money for your comfortable retirement or health purposes in the future, then you really need to think about what you're getting into and reduce the amount that you're exposed to so that you're not taking that bigger risk. Because the reality is your children in that scenario will have time to recover, but you won't, particularly not if you're retired and you don't or can't get back into that workforce situation.
Absolutely. And I think there's another couple of things I documented down just to help me remember all the points. But one of the big things I think is really good is being able to help kids buy their first home, but also avoid mortgage insurance. So for anyone who hasn't been through that process, if you have less than generally a 20% deposit, you're going to have to pay for mortgage insurance. And when I bought my first home, I think we worked out that the mortgage insurance cost was funded by the first homeowners at that stage, but mortgage insurance can be significant. It can be tens of thousands of dollars. So being able to find ways to help them avoid that mortgage insurance can be really good. And there's a couple of ways to do that. I know you can obviously help them out with cash as a loan, so to speak, but you can also, I know there has been out in the place almost like a limited guarantee from parents so that the bank has additional security so they don't need to charge the mortgage insurance. Obviously, I'm not recommending that today. I'm just saying that's some of the things I've seen. The other thing I think, Tim, which is really, really important is I think being able to back your kids in some ways a real positive of it, albeit it can be a double-edged sword, is it can actually help them take on more risk. So if I look back as a financial advisor, I spent 20 years asking why. And I used to ask my really successful clients early on, what would you do if you had your time again? What's your advice for younger you? They were my sort of go-to questions. And one of them, they always said at the end of their lives or when they were in the end of their working lives was, I would have taken on more risk. And if I knew what I knew now. And so obviously, again, double-edged sword, but having the ability or to talk to kids about being able to back them sometimes can have some benefits. Like it could help them start a business. It could help them educate themselves. So being able to tell them, look, we'll cover your HEC so you don't come out with a big HEC debt can actually make kids a lot more likely to go do some education. Again, I'm not saying it's always right to do that. A change of career. So these days we're seeing people that are saying, well, I trained as a butcher or I was a bank manager or something and I'd love to go do something completely different. So being able to back them to change their career, buying another farm or an asset. So being able to say, well, look, if you want to start to grow your wealth and you want to buy another farm or you want to buy the property that your business is operating out of or an investment property, well, if something goes wrong, we'll back you. That can help them substantially. And maybe even just to start investing. So the big thing I found as a financial advisor is people didn't invest until well down their working lives because two things. One is there was never any free money lying around. It was always going back into paying for school fees or kids' costs or starting the business or paying down debt. Well, if you can actually help them by either gifting them some money or starting them up an investment portfolio so they start to learn how to invest, that can actually be a real positive thing as well. And I've done that for Sophie. And so one of the things I've done, Tim, and I've done this for a lot of clients, I did this for a lot of clients over the years, is I set up an investment portfolio for Sophie. It was just $1,000, I think it was, and we put $100 in a month. And the idea is we're adding to that each year, and then we're talking about that. And as she gets older, she'll start to see it, and it'll educate her. So that gift, shall I say, attached with education attached to it, will actually pay off tenfold down the track.
Definitely, Ben. The leg up, so to speak, is not always just about the money. It's often with a learning experience or a learning lesson attached to it.
Well, I think it's essential that it is attached.
Definitely.
I think in all cases, because if you say to someone, I'm going to help you buy your first home, for example, don't just give them the cash. Help them understand where that's come from, what it means, why it's important to get into a home sooner rather than later. Talk to them about mortgage insurance, talk to them about interest rates, paying off your loan sooner. I think the gift of money or financially helping your kids out without education attached to it is fraught with danger.
Yeah, because they won't understand the value of it. Not only the value to them, but the sacrifice that you're making or have made to have that ability later on in life. You're right. If there's not a meaningful discussion and an education or a lesson around that, then the value will be totally lost and an opportunity will be lost to really teach them that lesson.
Absolutely. And again, if let's say you've been really successful in buying investment properties, so that's your thing. Well, start to teach your kids that. Like if you're going to help them buy their first home, really invest the time to help them understand about buying that home or that investment property and why it's important. If you've been really successful with shares, help them buy some shares and educate them. And it's never too early. I think that's the point with that side of things, is it's never too early to do it. So I look at my little nieces and nephews. They've started looking at investing when they're 13 and 16. And I've sat down with them and I've spent time educating them on what investments are, why you should invest, what super is, so when you start to get it. And I think that can be really valuable on their journey, and those lessons will compound over time and probably yield a much bigger return than if you just gave them the deposit for their first home. Yeah,
absolutely. Particularly at that phase of life and that age, they're still sponges. They're still actually listening. Whereas in their 20s they know everything, and in their 30s they start to realise they don't know everything. So there's a bit of a period there where you really are listened to, and that education is easier, and that is those school age formative years. I completely agree with you, Ben.
Absolutely. Now, there's some real positives with doing it other than the obvious ones. So I thought we'd talk about some of the risks, because I think it's really important to do that, because we can sugarcoat it and say, get advice and make sure you do it right. But what are some of the risks? And the first one we talked about, which was parents or retirees generally have a stash of cash or investments lying around, so it makes it really easy. I said it's easy to dip into. The old death by 1,000 cuts, 10,000 here, $500 there, we'll pay this off. Compounds over time.
It can add up.
It adds up. But I think the problem with that is when people retire is a lot of people don't know how much money they actually need to retire on or to last their life expectancy. So they get to this retirement stage, they start to draw, they get access to their super, or they sell a farm and put the money into some investments, etc. They don't actually know how much they need. So you've got a pot of gold, let's say it's a couple of $1 million, or say $1 million even, and you say, oh, well, I've got $1 million, I'll just give the kids $50,000 to get them started. Well, how does that impact how long your capital's going to last?
Yeah, and what sacrifice are you making? What does that mean to your lifestyle? What does that mean to your level of comfort, to your safety net? We're providing a safety net for other people, but perhaps at the opportunity cost of our own safety net. So can I afford it is probably the biggest risk, and something you certainly would have seen in when you were in practice, Ben.
For sure. And I used to say to people, what's your number? So let's say you have retired and you've got some assets. How much do you actually need, and what's the impact of this? And I used to run what I called lifetime models, Tim. So I used to just do a simple projection based on how much money you've got, how much money you want to spend a year, some capital expenses, replacing cars, renovating something or fixing stuff on your house, holidays, how long you think you're going to live, how much you're going to earn in inflation. And we just basically looked and said, well, how long is your money going to last? And then if we wanted to do things like, we'd like to help the kids out with buying a house, little Mary needs $50,000. Well, how does that impact your lifetime model? And in some cases, it was like it had no impact. It was an easy one. It was like, okay, this has no material financial impact on your life, so you can materially go and do this. Yeah, you've got to work through the logistics of is it a loan? How are we going to give it to them, etc. But I think it could have none. Others, I've seen it done. It's like, well, you're going to have enough money to retire on, but now you're going to run out. And when you're going to run out is when you're the most vulnerable, when you're 85 or something like that, or you're 80. And so it becomes a big issue then. So you really need to know, actually, can I afford it? Then if you go back a step and you go, okay, well, I'm not retired. I'm say 50 and my kids are coming through and I want to help them out. And you go, well, are you going to have enough money by the time you hit retirement to then last the rest of your life? And you run the numbers again and you look at it and go, oh, well, if you took that money and gave it to the kids rather than putting it into your nest egg, you're not going to have enough money to retire on.
Yeah, which means you can't retire when you want to, and will your health enable you to keep going? And they are the sorts of really important questions that must be asked before any decision is made to give particularly a considerable or a very meaningful financial gift.
Absolutely. And I think one of the things is, and I'll drop my mum under the bus, I do this all the time, so she'll probably be the only person that listens. I always say my number one fan, but she would give away her last dollar to her kids at her detriment. That's what she'd do. That's the way she would sort of roll. And then, of course, luckily myself and my sisters aren't those sort of people. We would rather see her spend it and enjoy it than us get it. But a lot of people aren't like that. A lot of kids aren't like that. So you got to be really careful that, you see this self-sacrifice and, it doesn't matter, I'll do it a little bit tougher, but I want to help my kids out. You have to look after yourself because you're retired a long time. And you don't want to be getting to let's say old and your vulnerable age and be very, very poor, because I think in the future the age pension's just not going to cut it and aged care is going to be expensive.
Yeah, rising healthcare costs, all of that particularly combined with the aged care is there's a fear out there of people running into money. And we see that amongst our client base even now, Ben, who objectively have done very well for themselves, but they've been brought up by post-war parents who've always told them that you need to save for the rainy day and you need to live within your means and live frugally. There's a perception out there and a fear that even though their financial advisors are telling them that you're going to be okay, that you will not run out of money if you're reasonable with your decisions, there's still a psychology and a mentality around that and living that particularly frugal lifestyle. But one of the cracks in the body armor of that is helping children. And I've got the rose-colored glasses, Ben, with my daughter, so I can understand it firsthand. She's not a struggling early 20s something who's trying to buy a house, but I can see that certainly that drive and that desire when she gets to that age will certainly be there. And I can 100% understand why people go down that road.
And another one, Tim, and you're probably the best one to answer this or give comment around this, is the guarantor thing. Guarantors seem a really easy thing to do. There's no outlay. I want to buy my first home. Can you go guarantor? I need to borrow some more money to prop up my business or buy another block of land, whatever it might be. Mum and Dad, can you go guarantor? And of course, on the face value, you don't have to pay out any money. It's nice and easy, and you sign the documents and off you go. And you would obviously see people doing that all the time, because the first thing the bank wants is you to go get independent legal advice to tell you the risks. So you want to unpack that a little bit for us?
Yeah, I'll unpack a couple of things there, Ben. Firstly, I just want to make a comment on that lender's mortgage insurance, which we touched on. So with the residential purchase market, that is one of the more common reasons we see the guarantees being put up, because mum and dad sit there and say, well, your lender's mortgage insurance is $10,000 or $20,000 or $25,000, depending on the value of the property and the deposit, etc. I don't want you just to throw that money away, because if you capitalise that into your loan, we all know we end up paying 2 to 3 times the value of the home in interest over the amortization of the loan. So you think this $20,000 mortgage insurance policy now is going to cost me $40,000 over the life cycle of the loan. Mum and dad say that's crazy. You're just burning that money. I'll either stump up the cash, or if I don't have the cash available, which most people don't, but they do have, say, equity in their own home or their own properties, then the bank says, well, I've got a great solution for you. You can sign a personal guarantee to plug the gap in that equity, if you like. And you're absolutely right, Ben. That is a really, really common thing that we see in practice, because we have to sign a certificate to say, dear bank, I have spoken to Ben and Sarah, and I have written them an advice, and they understand what they're getting themselves into. And if you tap them on the shoulder and they must pay, then they have acknowledged that they will pay. That's the kind of certificate that we have to sign for people by giving them that advice. So mortgage insurance, a lot of people around the barbecue chat don't get the message that the mortgage insurance doesn't protect the borrower, right? It protects the bank. So if you default on a loan, the mortgage insurer will pay the bank out, but then the mortgage insurer will come after you as the borrower, and you're still required to pay that out, right? So it's not like insuring your home, where they just pay you out and you go back to normal life if your home gets damaged.
That's a really important point, Tim. So let's just re-say that so people really get it. So the insurance is paid for the bank, not for the lender. So for you. And so if you default, you lose your job, you get sick, something goes wrong, the bank comes in and says you can't pay your loan. The mortgage insurance says, okay, we will pay it on that insurance policy. They pay it to the bank, and then they come back and they essentially sue you for what they've had to pay the bank.
That's exactly what happens.
Even though you've paid for the insurance.
Yep, you paid the premium, which we're all used to insurance, where I insure my car, I have an accident, I pay the excess, and my car gets repaired. Fantastic, I've now got my car back. Lender's mortgage insurance is a nasty and very different type of insurance that protects only the bank and not you, the person who's paying for the premium. So in that scenario, the insurer would then sue you because you defaulted on your loan in the first place. So again, it's a very, very expensive insurance. If you capitalise it in your loan, you end up paying it at least double what the premium is over the life cycle of the loan, with all of the interest, because you're paying interest on that premium which you had to pay up front. So for all those reasons, mum and dad then say, well, that's crazy. That's just such a waste of money. I've got equity in my home, or I've got, the ability to provide that guarantee. So I'm going to help you through this. So that's number one. The other thing I probably just wanted to unpack is, across the sibling group, you need to make sure there's transparency around that support, and making sure that you don't breed resentment by accident by helping, for example, one child but not another, or one grandchild and not the rest. And that's something that I think is very important, and we've seen done really, really well, that the opportunity for that support is very, very transparent, so everybody knows about it, right? It's not done in secret, and it's not discovered upon somebody's death and they get very upset about it. But the reality is, if you help one of your children or grandchildren, you really need to be prepared to help all of them in the same or nearly the same meaningful way. What's your perception on that, Ben?
Well, I think it's really important. I mean, there's one thing I'd want to say first is, it always doesn't have to be equal to be fair. I think that's the first thing, is just because you give one child $1 doesn't mean you have to give the other child $1. I think that's really important to understand. Some people might want to, but it doesn't always have to be. So someone you might go guarantor for, and the rest of the children you may not, because they don't need it, and you help them out in different ways. I'm going to make these statistics up, because what is it? Something 99% of statistics are made up. And so I'm going to make mine own up. But I read somewhere a number of years ago out of America, and I think from memory it was something along the lines of, they'd estimated 80% of all estate disputes, so families having a dust up after someone dies, could have been avoided if they'd had a discussion about what was in the will before mum and dad died. And I think it's the same with this sort of thing, is most people don't want to talk about it because it feels either dirty that we're helping one at the moment and we don't want the others to know. But they're the sort of things that get swept under the carpet, but they pop up invariably. And we all know families will quite often have their secrets that everyone knows, but we don't talk about. So we all know Ben got help from mum and dad, and everyone knows, but nobody talks about it, and it breeds resentment. And I think this is one of the major downsides of helping your kids or grandkids financially, is not having that discussion with them and the rest of the family so that it's all very transparent. Now, obviously, you have to play your cards right and you have to be intelligent about the different personalities and different positions. But I think it's really important to have that discussion, absolutely, and the transparency.
Yeah, we find that, Ben, that the worst outcomes are the ones where there's secrecy involved. And although they're difficult conversations to have, not only around our own mortality when we're talking about estate planning and succession planning for our clients, but in particular those financial support while you're alive, that if there's whispers around the Christmas table that so-and-so got helped and so-and-so didn't, we call it boxing at shadows, that very often the reality of that financial support may have been of a modest nature, but by the time it goes through 7 or 8 sets of lips and ears, suddenly they bought them a house, or the actual value of it has suddenly increased and grown between that game. But we do find that the transparency, although they are very at times awkward conversations to have, they will produce a much better long-term outcome for everybody involved. And the last thing you want to do is enter into a very well-meaning, well-intentioned legacy, let's help our lineal descendants type of arrangement, but then cause a family feud, because it sort of defeats the purpose. It's really not worth helping your children if they're going to become estranged from their other loved ones and other members of your family. So again, we really do counsel people into understanding the impact of that, understanding that the reality is that it won't remain a secret. Okay, families do talk, and despite promises being made that we'll never tell so and so, it will come out one way or another. So you're better off just having it out in the open in the beginning, and then, like you say, Ben, it doesn't have to be equal to be fair, but if there is a form of support that somebody else doesn't get anything, then you do run that risk that it breeds that resentment. And once that resentment starts to build and fester, it can be difficult to rein it back in. And, prevention is the best cure, as they often say.
For sure. And I think that comes back to that. Intentions are irrelevant. It's all about outcomes. For most people, they want a happy, strong family. That's their goal. Their intention is to help people out. Their outcome is that they get a fractured family, which is the last thing you want to do. And I think this is a really good point to jump in and say that it's also super important to have the discussion with the person you're assisting. So, for example, if it's, say, your son and daughter-in-law and you're helping them buy their first home, or whatever it might be, have the discussion with them about it, about why you're lending them the money, what impact that's having on you. So, for example, we're dipping into our retirement savings to do this. Your expectations, do we expect this money back? By when? How? And so make it really clear and have that discussion. Don't just turn up one day with a check or with a promise of, here's some money, we'll help you buy your first home. Have the discussion up front and be very, very clear and document it. And again, it may not be the fact that you necessarily need to get lawyers involved necessarily, but document it, write it down, make some minutes, send an email. Bill, we're going to lend you the money to do this, but we expect it back if you can start making repayments back over the next 5 years, or this is a gift, or this is a loan that, if you ever decide to sell that asset, we want the money back, etc. Like, have the discussion. And then, because I see a lot of resentment build over time when money's been lent. So the simple example is, we lent my son or my daughter and son-in-law money to buy their first home. They've got in their first home and now they're off to Fiji. Or they've just bought a new BMW or a Land Cruiser or a $50,000 caravan. And the parents sit there going, well, we busted our butts to get that money. We've lent them some money to do this. And then they're off, going on holidays or spending money on other things when they could have spent it on their home. So have the discussion about, what the expectations are. Yeah, those ground rules and those expectations, Ben, and that's, I suppose, part of what we're talking about with transparency, not only transparency between the recipient of the financial support and the person giving it. So typically we've talked about those parent-children or grandparent-grandchildren relationships, but also that wider family group. So the classic example we come across is we're asked to document
a commitment from a grandparent to pay the school fees for their grandchildren. Okay, wonderful thing to do, gives them a fantastic start in life and can really set them up if that goes the way that everybody hopes it will. When you start asking some questions and saying, well, do you have other grandchildren? And, oh, yes, there are other grandchildren. They live in Sydney, though, and, they're well-heeled, or so-and-so's got a good job, and so they don't need the support. They're the sorts of things where the alarm bells ring for us to say, well, although it may not be that they need it necessarily, you really need to, at a minimum, let that other child know that you are supporting another stream within the family. Because if that is discovered in the wrong set of circumstances, and that could unfortunately be at Christmas, or even worse, it could be discovered once mum or dad have passed away, and then you've got that very difficult grief plus money equals a fight. And that's something that unfortunately we've been through with our clients, and it's just a horrible experience for everyone, and certainly not the legacy that you'd really want to leave behind if you had your time.
Yeah, and a little bit of discussion up front about it with the family, transparency would be uncomfortable, but it would save a whole lot of hoo-ha.
Yeah.
The other one, Tim, I see is be careful varying the terms. So I've seen many occasions over the years where families, and I'll use a farming analogy or an example, is where the next generation's taken over some farming land and they've said, we will pay you an adjustment or a lease fee for that land. And then, of course, times have got tough, interest rates are up, bit of a drought, etc. Kids come back and say, oh, we can't really pay you this month or next month. And, of course, mum and dad go, oh, absolutely, we understand, etc. I'm not saying you shouldn't be compassionate and shouldn't vary the terms, but what happens is for some families it becomes a slippery slope where we can't pay this month, we can't pay next month, or 2 months later, oh, the kids have got to get braces, can we turn off? And then eventually it becomes this icky discussion where mum and dad are saying, we need the money back, because in a lot of cases people need that money back, or we expect that money back. We've got to have the discussion, and it just becomes really uncomfortable. So try not to vary the terms of the agreement. And if you do, have a discussion about the variation. So yeah, absolutely, we're financially able to do this. We're not going to charge you the adjustment fees this year, but we expect it to start next year. Have the discussions. And it's funny, I wrote two things down that I've said many times, and it can be a bit contentious, but to dads, I'll say man up and have the discussion. Don't hide down the back paddock or in the machinery shed because you don't want to have that hard discussion. And for mums, tough love is still love. Sometimes you've got to say no, suck it up and work a little bit harder, or you're going to have to take a bit of pain here and sell your fancy car or not go to Fiji this year or do a holiday to Hamilton Island. You're going to have to suck it up and your lifestyle's going to adjust. So there comes a point where you do sometimes have to do tough love.
Yeah, it's always difficult to watch something or someone you love suffer and struggle, but sometimes those suffer and struggle experiences build the character, and that's often the difficult balance that you've got to strike by, I want you to do really well in the world and I want you to be the best you can possibly be. But if very successful people look back through their lives, they'll often tell you about the really hard times just as freely as they'll tell you about the very good times. So yes, the truth is, and we talked about those guarantees earlier, Ben, and just a point I wanted to make here is that signing a personal guarantee to support a loan for a child for whatever that's going to be, hopefully it's property and not a car or something that's a liability and deteriorating in value, you need to be prepared to either force the sale of that asset to save your own guarantee, or if there are some ground rules around that, for example, you say to your children, I'll support this guarantee, but I'll only sign it for 3 to 5 years. The bank probably won't like that. The bank will probably say, I need that guarantee for the life of the loan. But you say to your children, I need you to be in a financial position within that 3 to 5 years to refinance that loan and get my guarantee out of there. And then we always see it. They'll take the trip to Fiji. They'll buy the new car. Often they're really, really obvious examples of financial irresponsibility. The less obvious ones are families get started, kids come along. Kids are expensive. Grandparents or parents are very reluctant to say, I really need to get tough with you now that the next generation is here. And they say, well, I've just had to take some time out of the workforce because the kids have come along, all those types of things. But those guarantees they're really fraught with danger. And we are very thorough in our advice to people. We generally tell them not to sign them. And if they do, they need to understand that, particularly if you've got a single asset being your family home and you are providing that guarantee to your children, you actually might lose the family home if things don't go the way that we'd like them to. And that's a really horrible thing to think about, but something that you need to think about to make sure that you understand what you're getting yourself into.
Absolutely. Yep. Because you don't necessarily always know the financial position they're in. So you could be providing the guarantee thinking that everything's okay when you find out they've got $2 million worth of business debt that's in arrears and they're in an awfully difficult position. So, and then they have to sell their home and pull their kids out of private school or their schooling. And, that becomes a real challenge. So the other thing I thought of, Tim, which is really interesting is pay for some advice for the kids. So sometimes I have done that for a few clients over the years, is where they've come in and they said, look, our kids really need to get ahead. They need to think about retirement planning, paying down their home, getting set up. So they've actually come along and said, look, we want them to get some advice. They're not going to pay for it because they don't see the value of it yet, but we do. Here they are. And I think that's been a really good way to get them started. Another thing is to talk to them about insurance. So personal insurance. So if you're going and borrowing some money and you're worried about them getting sick or ill or injured or something like that and not being able to pay their mortgage and your guarantor, well, tell them to get some income protection or some life insurance, TBD or trauma. So I think that's really important as well, because that can actually fill a gap that you might have felt you've had to fill if something actually went wrong. And that does happen from time to time. People have the car accident, they get cancer or something like that, and it becomes a very significant financial problem. Yeah,
and the analogy I use, Ben, that if, when I first got into business and I bought into a practice, the bank said to me, yes, we'll lend you some money, but we really need you to increase your life insurance component so that if something happens to you, that we know that there's enough cash to pay out the loan. Oh, and coincidentally, we sell life insurance. You remember those days, Ben. So put yourself into the shoes of a lender. Forget for a minute, if you can, that you are parents or grandparents, and think like a bank. What's your risk profile and how will you get paid if unfortunately there's a catastrophic accident? Either it's total permanent disability, or it's an income protection issue, or it's a life insurance issue. Yeah, you really need to suggest that insurance gets looked at and reviewed, and make sure that it's adequate for the financial circumstances of whoever you're considering giving that financial support to.
And that can fill a hole for you. And the other thing, Tim, being a lawyer, I thought we might touch on a little bit was binding financial agreements or prenups. This is a really contentious area, and one that I don't have very little knowledge at all, and we probably don't have the time today to really dig into it, but can you just unpack that a little bit? 50% of marriages end in divorce, let's say, or relationships. If parents are gifting or helping, are these easy to put in place? Are they difficult? Do they stand up in court roughly? You want to unpack that a little bit? Yeah,
let's do that. The binding financial agreements have been well reported on in the last probably 5 years for all the wrong reasons, actually, that they have been a strategy that people have implemented from a preemptive family law perspective for a long time. We've all heard about the prenups from the American-based movies. There is a similar thing in Australia called a binding financial agreement. They were very common where there was a disparity of wealth in a relationship. So someone brought a lot more to the table, or it was a subsequent relationship, and perhaps there was a blended family arrangement. But what we found over particularly the last 3 to 5 years is they have been really well tested through the courts, and the courts have thrown a fair few of them out for a multitude of reasons. So in a nutshell, they're not the semi-guaranteed protective mechanism that everyone used to think that they were. They're a lot more difficult to implement nowadays. They're a lot riskier to implement. And we're actually finding a lot of even the very specialist family lawyers are refusing to do them because they just can't give clients comfort that they're going to hold up if the document itself is tested. So they're simply saying, I'm not comfortable doing that document. And because of that, the ones who are still doing them are increasing their prices because they can. And sometimes that can be a very expensive exercise that doesn't actually give you that peace of mind that, remember, we really want our clients to get. So although we're not specialist family lawyers, we know lots of specialist family lawyers that we refer our clients to for those types of jobs. binding financial agreements are a good thing to consider, but they definitely have holes in the Kevlar, as we call it. They're not the bulletproof vests that everybody thinks, or perhaps we thought that they used to be.
But again, it's in some people's scenarios, it can be a really effective tool to protect that intergenerational wealth for gifts coming through, etc., especially in businesses or with large farming assets, is to be able to have that discussion and maybe have one in place, or if you're gifting, having agreements in place that we are gifting assets. Because the horror example, and you've seen it play out, or I've seen it play out many, many times, is when, you know, a gift of a farming block of land or all the farm is given to the next generation, the relationship breaks up, and next thing the farm gets sold and it's lost. You want to avoid those sorts of things for obvious reasons, but a prenup's probably not going to be the be-all and end-all. It's going to have to be also getting advice around making sure if you are gifting or giving intergenerational assets, that there are other mechanisms like loan agreements, etc., in place to be able to cover you.
Yeah, there's a few tools in the toolbox, and binding financial agreements are definitely one of them. They're still around and they're still effective in certain circumstances, but again, they must be planned out. There has to be independent advice from all parties involved. You can't spring it on your spouse on the wedding night or even on the day after. And there was a really terrible case about a situation very much like that. So they just have to be used in the most appropriate circumstances, but definitely a tool in the toolbox.
Yep, for sure. And the other last thing I thought of, Tim, was I think I've said this to a few people over the years, is if you'll see a gap in your family, like you're seeing your kids maybe aren't great with their budgeting or saving or cash flow, and you think they're too old to listen to you or to be taught, start young if you can. But if you can't, go back to your grandkids. You know, talk to your grandkids. I remember my grandfather talking about money when I was little, and he was very smart with his money. And he used to talk about, you know, saving money, not spending all your money. He used to invest, so investing money, etc. He had 5 jobs. He grew out of the Depression, and he had 5 jobs. He had his full-time job. He had an oyster lease, a farm. You know, he was just an absolute a hard worker and real entrepreneur. And so starting to talk to your kids about things like budgeting, why it's important to budget, why it's important to save, but also to invest, because that's the missing link I quite often see, is a lot of kids are taught through the generations to save and to be frugal, but they're not taught to invest that money. And that's the missing. Yeah.
No, you're definitely right. You and I have had many conversations about this, Ben, about the lack of formalised financial education through the schooling system. And, you know, you come out knowing how to get educated and be a worker, not necessarily how to be a business owner or how to be an investor. So one of the best ways you can help your descendants is to teach them the lessons that you've learned. And a lot of that is about that financial education. Yes, you can pay their school fees and you can do lots of things to support them financially, provided you've thought about it, you've got the risks and hopefully documented it, as we've talked about. But if you impart wisdom upon them, nobody can ever take that wisdom away. And that is really something that we see done very, very well between the grandparent and grandchild relationship, because none of us really want to listen to our parents because we know better, Ben, don't we? We're going to do things differently. We're not going to be like them.
Of course.
But it is a special relationship between grandparents and grandchildren. And if you can get that financial education in there early, when they're still listening to you and they still think you're amazing and you know everything, then those lessons will stick with them for the rest of their lives.
For sure. And I think if I look at the last thing, Tim, just from a legal point of view, is the estate planning side of things. That if you are giving to or assisting one child or grandchild, and you say, "Oh, it'll work out in my will," in other words, I'll just sort that out. They'll get, you know, I gave Ben $30,000, so when I die, Tim will get, you know, $30,000 less. You really need to think through that, don't you? Because, you know, I've seen people where, you know, we helped out one child with $200,000 15 years ago, and then when they die, we'll give you $200,000. Well, the original child's had that $200,000 for 15 years. You know, they could have turned that into $500,000 or maybe more, and you get the $200,000, and that's a problem. Or you might give them $200,000, they pay it back, you forget to update your will. So I think it's really important that if you're thinking along the lines of this is at a pre-estate asset, so in other words, I'm giving them some money now, but the others will get squared out in my will, that you actually document that and chat to your lawyer and make sure it's in there and done appropriately and regularly reviewed.
Yeah, certainly. And that's why we say to a lot of our clients that if you're entering into this financial support relationship hoping or expecting to get this money back, that's a very different thing to what is more common, which is bringing forward that inheritance because my kids or grandkids need it now and I'm hoping to live till I'm, mid-80s or mid-90s, whatever the plan is. So a lot of these discussions, Ben, actually shake out of the estate planning discussions, and we do get lots of clients who come to us and say, I have lent some money or I have gifted some money to my child already. And then we start asking some questions about, well, is it a gift? Is it a loan? Is it clear to them whether it's a gift or a loan? Because gifts and loans are treated very differently, not only from the estate planning perspective, but it's a very different scenario if you do pass away. A loan must be repaid and it's an asset of your estate. A gift is a gift and it's gone and you never get it back. And that needs to be made clear. But the estate planning, yes, it does often come after this, but we find that the discussions that we have on a more meaningful level are people come to us when they are approaching retirement, for example, or coming up to retirement, and they're staring at getting access to those retirement funds that they've squirreled away for so long. And they say, I'd like to put my estate plan in place, but I also would like some advice on how to help my children in the short term rather than waiting another 30 years when they're probably past the point of actually needing it.
And that's one of the true values I see with Sophie of being able to help her is if I can get her to start building her wealth or being financially intelligent as young as possible, the power of compounding over time. If I knew what I knew now and started at age 20, I'd be 100 times further ahead than I am now. And I'm a financial advisor or was a financial advisor. So if you can start to get those kids to do things earlier, if they want to buy a house, buying a house, getting a business up and running, investing, it's really, really important to start early. So
yeah, it's amazing how many people you talk to, Ben, and you've touched on this, that they say, I wish I'd taken more risk when I was younger. That is a very common theme that we see as well. But everybody says, I wish I'd started younger. That I wish I didn't wait until I was in my 30s or 40s to really take that opportunity or take that risk. There is a very different, mentality to doing something as a teenager or in your 20s than there is when you've got other responsibilities like families and things in those middle ages of life. So yes, start early. That's what all the investment gurus say, don't they?
Absolutely. And if you look at, I think it's really important to make financial intelligence or financial wisdom, so being smart with your money, investing, providing for yourself, building your wealth, leaving a legacy, all those sorts of things should become part of your family's discussions. I know in the Jewish world, for example, one of their real strong beliefs is being financially secure. So they educate their kids very young about being financially secure, starting a business, being intelligent and respecting their money, and then being able to support others. And so I think it's really important to start having those discussions in the household around money. And I know in the past, the problem's been is money's been a very taboo subject. When I was growing up, you didn't talk about money. From my grandparents, you didn't talk about money, it's dirty, you just don't have that discussion. Whereas nowadays we need to change the narrative and start talking about money. And the sooner we can start talking about money with our kids and grandkids, the sooner when things like financial assistance or putting away for their future or helping them out, etc., it's a lot easier to broach the subject because money, wealth building, debt, repayments, budgeting, investing, etc., are part of their vernacular or their vocabulary, and it just becomes easier to have than never talking about money because we don't want to talk about money, and then all of a sudden at 30 say, Tim, we've got to sit down and talk about the fact that you haven't bought a house and you've just gone to Hamilton Island and spent all your money on a new car. It becomes very hard to have the discussion with them then.
Yeah, it definitely removes that stigma, Ben, around that you've touched on quite rightly. We do still come across business families who don't talk about it. Sometimes that's about a refusal to talk about your own mortality, what happens when I pass away. And I respect that. None of us really want to talk about that at the dinner table. But we do find that the stronger families do engage with that transparency. And like you say, from my perspective, I believe transparency is a very positive thing, and it can also lead to that wisdom and removing that stigma, so that often that initial conversation is not the only one that you have about, what happens if. It's an iterative process that can change over time, but without that stigma associated with it. We do still find some farming and grazing families when we interview the children, which we always insist is part of our succession planning. We want one-on-ones with the kids, so mum and dad aren't there breathing down their necks, listening to what they're saying. They often say, we've just never spoken about it because mum and dad don't like talking about money, which, yeah, I respect that, but our position is that attitude does have to change because you're missing out on lots of different learning experiences and you've still got that stigma around that topic, which means that it'll never be spoken about. And then you've got that grief plus shock potential if something does happen to you.
For sure. And I think also, Tim, if you're having the discussions with your parents about, especially using the farming terminology, if you're talking about succession planning a farm, for example, or a business, it's amazing how the conversation changes when you say to the next generation coming through, they're looking at the farm or the businesses as they're going to take it over and mum and dad need to let go. And then you have the discussion about money and saying, well, the reality is mum and dad need to retire. So they need a certain amount of money to be able to step out of the business or the farm. They need X amount of dollars. They've only got their bucket half full, for example. So your job over the next 5 years or 10 years until you succession plan this business or farm is to fill that bucket. And then you get to take over the next generation and then you got to fill your bucket to hand over. And when you have that open discussion with the kids or the next generation about their role in securing mum and dad's future and how that benefits them, it can change the whole discussion. Whereas if they don't have that discussion and they see mum and dad trying to put money into super or off-farm assets, all of a sudden it becomes, mum and dad just keep pulling money out of the farm to go and, put into their nest egg. They're just greedy. And I've heard that many times before. I've heard that. You'd be surprised when you get families apart and you have the discussions, you unearth that's the fact. So again, having that discussion about how much do we need, how much have we got, if we give this farm to you now, we can't afford to retire and, we're 60 and we're going to live till we're 90, that's 30 years you're going to have to be paying for me. That's the reality. So it's really good to start to have those discussions and you want to do it earlier rather than later because it makes it so much easier.
Yeah, and gosh, from our perspective, Ben, please don't wait until someone is sick to start that process and have that discussion. That's something that unfortunately we do come across, and I don't want to be too negative. Like I say, I like to give people the positive outcomes, but sometimes the best plans can take years to really implement, and there are lots of taxation reasons why giving us 3 to 5 years to implement a plan is a lot better outcome. But if you wait until there's failing health in the scenario, then you don't have that luxury of time.
Excellent. Well, I think I think we might put a pin in it there. I think that's a great place to stop. But I think my shall we say, suggestions would be is, if you're going to help your kids out, think about the best way to do it. Don't just necessarily open up the checkbook. Think about having the discussion with them, but get advice. If you are dipping into your nest eggs or borrowing money to help them or doing guarantees, etc., is speak to your financial advisor, speak to your accountant. What sort of issues is this going to have for us? And also speak to your lawyer, especially around estate planning, family law, and documenting things. And I think that's really important. But above all, my personal thought is have the discussion. Treat it like it is a transaction, and the intention is to help them, but the outcome you want is to keep a strong, happy, healthy family. And I think, always keep that in mind.
Yeah, that's the name of the game, Ben. The money is supposed to empower and fulfill your lives, not be a wedge that drives people apart. So that's really what you need to focus on when you're planning these things out.
And that's why you make a good lawyer, because you use less words to get a great point across. Whereas my wife says, one day, Ben, you're going to run out of words. You just keep talking. So very articulate. Now, one of the things, Tim, we talked about, just to tie this off now, is a really hot topic I think we're going to talk about at some point in the future is death taxes. You mentioned it the other day. And I think that'd be a really good topic, and just gives a bit of a teaser of why you think that'd be good for us to talk about.
Yeah, so as a general rule, Ben, people don't like talking about death or taxes, so we try to avoid those topics. But there's been a lot of whisperings in financial press around the fact that we've been lucky in Australia. We abolished death taxes a generation and a half ago, and apart from a few peculiarities within the superannuation environment, there is no such thing as a death tax in Australia. But what we're seeing happen is that in a post-pandemic world where the balance sheets of governments look really terrible and they're looking for ways to recoup that from other taxes and things like that. There's been a lot of polling and a lot of testing out there amongst the political fraternity to say, well, what's the general Australian attitude towards death taxes as a means of repaying a government debt? So amongst our client bases, there's a fear around it, particularly people in the agribusiness space, because they are very asset rich and cash poor.
And there's a big history of death taxes undoing a lot of families in the rural world.
Particularly around the British system, the UK system, where often some of those family farming estates actually had to be sold because the death taxes were so great and the cash was just not available in order to refinance and pay the government upon death. So it's a hot topic because giving assets during your lifetime generally has a more favourable outcome than paying death tax, for example. And in a lot of countries, that's a strategy that gets employed. So it's definitely on the radar. I think it's a hot topic, and it'll be a really interesting one to come back and revisit another day, Ben.
I think it would too. I think there'd be a lot of people that'd be very interested to be hearing about that. And now, Tim, the last question. What's your definition of true wealth?
True wealth, Ben. I'm really going to be a typical wanker of a lawyer and actually talk about money instead of talking about family fulfillment and all those other good things. I actually think that true wealth is about working because you want to and not working because you have to. So for me, that's just around those basic financial security considerations. So I actually think true wealth, particularly focusing on that financial sense, is having enough money to feel comfortable, to sleep at night, and to have that peace of mind that you are going to be okay no matter what happens. And to me, that's a really important part of why we work and why we work hard and while we try to build wealth. It's about that level of comfort and peace of mind.
Perfect. Yeah, and look, from my point of view, Tim, I said that you should always try and achieve financial security because that gives you choice. And choice is what we all should be aiming for, the choice to do what we want to do when we want to do. And the more secure we are, the more choice we've got.
Fantastic. We're in the lucky country, Ben, and that's never been more obvious than in the last 2 years.
Yeah, exactly. Well, excellent. Well, look, thanks very much for your time, Tim. Really appreciated it. I'm sure everyone got a lot out of your input, and yeah, look forward to the next one.
Yeah, looking forward to it. Thanks, Ben.
If you want to get in contact with Tim, head on over to Tim's business website, which is www.rhrivett, R for Roger, H for hello, Rivett, RIVETT.com.au, or just Google Tim Rivett Lawyer. The information contained in this podcast is general in nature and for education purposes only. It's not financial advice. It's not legal advice. No one should act on the information without appropriate specific advice for your particular circumstances. I'm a former financial advisor and I am no longer licensed and cannot and will not give you specific or personal advice in this podcast. The Financial Bloke accepts no responsibility for any loss or damage occasioned by any person acting or refraining from acting as a result of reliance on the information in this podcast. Don't forget, you can also now join our new private Facebook group, The Financial Blokes Wealth and Wisdom. And thanks for joining me again today. And I'll catch you with a new episode in 2 weeks' time.